Hi everyone, welcome. We're just waiting for a few more people to join in, so we'll just wait here for a moment, and as people join, we'll let them come in. We will work to be prompt, start right at 9 o'clock, but we'll let those last few people roll in now. Couple housekeeping things. If you have a question, feel free to type it into the live event Q&A. We'll get that. I will do my best to answer these questions throughout the presentation or collect them at the end if I don't see them throughout. So I'll kind of be watching that while I present. So bear with me if I don't answer you right away. I will review them again at the end and answer any questions then. Or if it's something a little more personal and you don't want to share it in the group, myself or Jake will reach out and just touch base with everybody after to answer any questions that happen to come up. Give it another minute here. All right, I see the last couple people rolling in here, so just bear with us. Good morning. Welcome, welcome. All right, I think we have a few people who are going to sort of roll in throughout, but I do want to respect everybody's time who took the time to be here this morning. We're really grateful to be here with you today. I am a big believer in that it's important to give back to our community, and I'm very excited to be able to share with you today some different options and strategies how to make that more efficient. Again, we're very lucky in what we do and where we are in this life and in this world, and I think it's important that we take the time to give back, and I'm very excited to be here sharing with you some knowledge that we have and being able to use our expertise in the field that we enjoy doing to make a bigger impact and a bigger difference. So our agenda for today, we're going to just do a brief introduction of who we are here at the Kilgore Group. For those of you who don't know myself and my team, we'll introduce you. Then we're going to jump right into the meat of the presentation, talk about charitable giving, some tax considerations, your options with regards to charitable giving, and creating a legacy. Again, I'm so grateful to be here. We really are passionate about helping individuals, helping our clients, but also about helping our community and helping improve the world and just make it a better place when we can do that. So the fact that we get to use our expertise and our knowledge to have a bigger impact is something that I'm so excited to be able to do and sharing with you today. Brief introduction to who we are. Myself presenting, for those of you who don't know, my name is Lindsay Kilgore. I am an executive financial consultant here at the Kilgore Group, and I have been with IG now for 11 years. I am a certified financial planner. I have my Master Financial Advisor in Philanthropy, and quite excited to be here with you. I'm also very excited to have Jake with us as well. Jake joins us from a wealth of knowledge from external industries and has come to us through Roy Nat. Chandra is a great team member. She has joined us recently after graduating from Laurentian University. She's currently completing her MBA there while working here full-time. So just tons of enthusiasm. And of course, Erin, our administrative assistant, who really holds the team together. The Kilgore Group is a business that operates here locally under Investors Group Securities Inc. Investors Group Securities Inc. is a branch of IG Wealth Management, a little different than the other Investors Group you're probably used to hearing about. And IG Wealth Management is a branch of IGM and, of course, ultimately of Power Corp. And a big reason we chose to operate under Investors Group Securities Inc. when we made that decision and moved to the IROC space was because of the history of IG and their belief in giving back. IG has committed to local and our global community. They give over $7 million annually. They were number 29 in terms of the corporate Knights. It's really a great company to be a part of that has a belief in the communities we serve. And that's something that's important to us here at the Kilgore Group as well. This is a small list, not inclusive by any means, of some of the charities that we've been involved in over the past, some of the donations we've made over Christmas gifts. I like to do a charitable donation for my birthday gifts as well, and partnering with when we do client events. So something that's really important to us is giving back to that community. Lastly, the reason we chose to partner with Investors Group Securities Inc. is because of their belief in planning. And that's something that's really important to us. We do believe in the plan, holistic planning, taking care of yourself, of course, in terms of making sure you're prepared for major expenses, prepared for the unpreparable or the unknown. Optimizing your retirement, of course, is very important, maximizing your business value, but also a piece of that is sharing your wealth. And that's what we're here to focus on today, is how can you share your wealth in a more efficient way? So, jumping right into what everybody's interested in today, charitable giving, some key considerations and opportunities for you to learn about. So I wanted to start by talking a little bit about why people give. And of course, people give to make a difference today. I don't think that that's a surprise to anybody. Everybody on the call obviously has something that's important to them. We're all aware of the needs that are out there, be that people in need, food banks, children's charity, clothing drives, also research, cancer, Alzheimer's. There's so many different reasons to give today. And I'm not going to spend a lot of time on that because the reason you want to make a difference today is usually fairly personal. The other things that I'm going to chat a little bit about today in terms of why people give is to create a lasting legacy, to set something up either in the memory of yourself or a loved one or a family member. And then lastly, tax savings. A lot of people give today really to save money on taxes, or they will give more because of the money they save on taxes. So of course, that's a really important piece of the puzzle. We're going to start on the tax side and then we'll move into the legacy. So I think first and foremost, I wanted to take a few minutes to just explain the basics in terms of charitable giving and how that affects your taxes. So when you give money to a charity, you get a tax receipt. That tax receipt is then used to get a non-refundable tax credit, meaning it reduces the amount of tax you have payable when you file your taxes. So with that, well, there's a few things to kind of keep in mind, or a few nuances. The first one is the fact that there are two different rates. There's a rate up to $200 and a rate over $200. So if you give over $200, you actually get 20 to 30% more bang for your buck from a tax perspective and tax savings on those donations. And some things that people may not know, if you are giving, small amounts over a few years, you don't actually have to use all those receipts in the year you give them. You can hold on to those receipts, combine them. You can actually combine spouses' receipts as well to push you over that $200 range and get that bigger return. The same tax implications are sort of true for corporations. It's a little different. So when you contribute or when you donate as a corporation, you get to deduct, as opposed to a non-refundable tax credit, you get to deduct the amount you give from either active business income or investment income. When you're donating, there's an annual limit for charitable donations of 75% of your net income. That's true for both corporations and people. And if you donate a large donation that's actually more than you would be able to save from a tax perspective, you can carry forward that donation for 5 years. So now that we've talked about how the tax receipts work or tax breaks work, I wanted to take a little bit of time to dig deeper on what your options are for giving. Most of us give cash, myself included up until recently. It's easiest, somebody knocks on your door, whether it's to sponsor a kid's team, give money to a cause, a walk, you name it. We tend to write checks and give cash. It's easiest, it's top of mind, and that's what we do. But you can also donate publicly traded securities. You can donate life insurance policies. You can gift registered plans, RSPs, tax-free savings accounts. You can establish a private foundation. There are lots of different ways to give. So let's look at what way is the best way. Let's start by talking about if you're donating today. If you're donating today, you can either give cash or you can give securities in kind. And what you choose to give is going to have a fairly substantial impact on the tax results of that gift. So when you donate publicly traded securities in kind, that means that you actually give that security. So let's say a stock that you happen to be holding, you've been holding a TD Bank stock, you give that publicly traded stock in kind, that TD Bank stock, to the charity of choice. And when you do that, you actually don't have to pay tax on the capital gain. So a little reminder for those who aren't familiar, if you have a security, let's say you bought a TD share for $100, it's grown to $200, that growth is considered a capital gain. 50% of it is considered taxable income. In that case, it would have been $50. and you would have to pay tax. If you were at the highest marginal rate, it would cost you $25 in tax on that capital gain. So if you donate it, you don't have to do that. So let's look at the difference between donating in kind then and donating in cash. Let's assume in this scenario, we have an individual who is wanting to give some money to a charity that means something to them. They want to give that money today. They're looking at donating $25,000. If they are, the typical person, like I said, we all do, most people go into their bank account or they get out their checkbook and they write a check for $25,000. Of course, that's a wonderful gift to give. It has a large impact. And it does provide some tax savings. So if you write that check and you donate in cash, your tax savings are $11,500. You get the highest non-refundable tax credit, which saves you taxes about $11,500. So the difference is what you gave up in, we'll call it spending money, to be able to make that donation. Now, the second option, as I mentioned, is to donate securities and to donate securities in kind. So let's assume that same individual has a non-registered portfolio and they have some stock or some mutual funds in there. Let's assume that they have a mutual fund that they bought 5-10 years ago for $5,000 and it's now grown to $25,000. So it has a capital gain. Instead of donating the $25,000 in cash, they donate that now $25,000 security. What ends up happening is they don't have to pay the capital gains tax. So they're getting an extra benefit in there. So they get the same $11,500 non-refundable tax credit for the $25,000 donation, but they also get additional tax savings because they don't have to pay tax on the $20,000 gain. A $20,000 gain results in approximately a $10,000 income inclusion, which at the highest marginal tax rate, we're talking about a $5,000 tax bill. If you're on a 40% tax rate, which is what we used here, you're talking about a $4,000 tax savings. So you've just taken the same amount of money, you've made the same donation, and instead of saving $11,500 in taxes, you've actually saved $15,500 in taxes. You're $4,000 ahead for making the same donation. That means you can either take that $4,000 and spend it on yourself, take a trip with your family, maybe take a volunteering trip, or you could increase your donation because you have a little bit of extra money that you weren't expecting to have. This strategy works really well personally. It also works very well corporately. So for those on the call, and I know there's a few of you on the call who have corporations, holding companies, operating companies that have investments in there, you can look at the same thing and have the same consideration. So as a holding company or as an operating company, you have the same options. You can donate through that company and you can either donate cash or securities. When you donate securities through a corporation, the corporation receives a tax deduction for the amount that was donated, which reduces the corporate taxable income. But in addition to that, you do not pay capital gains. Same idea as a personal donation. That capital gains is avoided when donated in kind. And with a corporation, what can make this even better is you also get what's called a CDA credit, or a credit to the capital dividend account. That credit to the capital dividend account is an invisible amount, essentially. It's not a real number, but it allows you to take money out of your corporation and spend it personally without paying any tax. So let's look at the numbers again. Easier to always understand things through example. So let's assume, same as last time, that you're a charity you're a corporation and you want to make a donation to a charity. You want to make a $25,000 donation to a charity. You can do that writing a check out of your checkbook, and that's going to have a profound impact. You're going to donate $25,000, which is, of course, a wonderful thing to do. And it's going to save your company taxes, assuming that you have the passive income to offset at a 50% marginal tax rate in the corporation, you're going to save about $12,500 in corporate taxes. Again, that's a great thing to do. Your donations only cost you about half of what you've given, which is obviously nice. But can we do better? Can we have a larger impact? And the answer is yes. Let's look again at the same scenario where you're going to look at donating shares in kind. So again, assuming there was a $25,000 security, mutual fund that happened to be bought, 5-10 years ago, you paid $5,000 for it. Now that value has grown, it's worth $25,000. So what happens? You do get the same $12,500 donation deduction for donating $25,000, which is great. You also avoid the capital gains tax. So that capital gains tax, again, $25,000 of value minus $5,000 of initial cost is a $20,000 capital gain. That's $10,000 of taxable income from that capital gain, which is about a $5,000 in your corporation tax bill. So you avoid not only the $12,500, you also get an extra $5,000 that you avoid. So $17,500 of corporate taxes saved. Here's where the step up happens that makes it even better. When you donate that security, the portion that was not taxable of the capital gain is credited to the CDA. That means that whole capital gain actually was not taxable. That $20,000 was not taxable. You get a $20,000 tax credit to the CDA, which means you can take $20,000 out of your company, have it personally to spend in your hands without paying any tax. Again, if you're in the highest marginal tax rate, that's probably about a $10,000 tax savings for you. So all of a sudden you donated $25,000 of securities and you actually saved more than that in tax. The tax benefits are closer to $27,000. So you had planned on giving something away. Now all of a sudden it didn't cost you anything. As a matter of fact, you've got cash in your hands to go and spend and do some home renos or go on a trip with the family. Or maybe now you can donate a little bit more. You can have a larger impact because that donation hasn't cost you really anything. And that's a huge thing to consider. And I think that as more people realize this and as we get the message out there that these options are available, we can, as a community, help more. We can donate more, which is fantastic. So, as I mentioned, taxes are, of course, an important part of the puzzle, something that is important to consider when you're talking about gifts, but there are other pieces of it as well. And the third piece that we said we were going to discuss today was the idea of giving a lasting gift, planning to give long-term. So when we talk about a lasting gift, we're talking about giving some of your estate capital. And it's important to realize that estates are taxed. There is income tax. It's a little different than the US and what we all hear about on TV, but there are some serious tax considerations when it comes to estate planning. And charitable giving can be a great way to offset that. So let's take a look at what happens when you pass away, what the tax implications are and what your options are available to that. So I like to joke when we say, who spends your estate capital? Your children, maybe a charity, and the government. The government turns out to be your favorite kid in a lot of scenarios. And that's because of the way the Tax Act works. So when you have RSPs or RIFs, when you pass away, those are considered deemed to be disposed the moment in which you die, and therefore they are all income the moment before you die and therefore taxable. Interest, dividends, capital gains, same thing. They're disposed the moment before you pass away. So those capital gains that maybe you didn't trigger throughout your life are triggered at time of death. You do get a few tax-free things. The government does give us tax-free savings accounts, life insurance, primary residence, but there is still quite a bit of taxable income at time of death. So we have some options and you can make some donations. Again, you can do a donation of a publicly traded stock security mutual fund at time of death. So if it turns out that you didn't spend that investment that you made over your lifetime and you want to give it and use all of the benefits we just spoke about at giving in kind at time of death, that's something you can build into your estate plan. Keep it in your hands in case you need it. And if you don't, give it in kind and have a great impact. You can also donate life insurance and registered plans as well. So talking a little bit about donating life insurance policies, there's a couple ways to do that. You can donate that policy now, or you can donate the proceeds of that policy in the future. And the tax implications, again, are a little different and important to understand. So if you make the charity your beneficiary, you own the life insurance policy, you can make changes, you can change it along the way, change the beneficiary, change which charity. What happens is, at the time you pass out, the death benefit is donated to the charity and you get the tax savings based on that donated amount. So you put premiums into the policy. In this example, you pay the premiums years over years, $40,000 goes in, Death benefit is paid out, tax-free of $100,000. That gets paid out directly to the charity. And there's a $46,000 tax credit that can be then used to offset taxes from RSPs that were liquidated the moment before you die, capital gains, those types of things. You can also make the charity the owner of your policy. You can buy a new policy and set it up where the charity is the owner, you pay the premiums on an annual basis. And what happens then is the premiums that you're paying annually actually become a donation in the year in which they're paid. So you get that tax credit up front. It's a smaller tax credit, but you're getting it sooner. An alternative option that kind of works with this as well, for those who have insurance policies perhaps set up that they don't need anymore, you got it when your kids were young, you had a life insurance need, now they're older, you don't necessarily need it, you're considering keeping it, canceling it, you can also donate an existing policy to a charitable foundation. You go out, you get a fair market assessment from an actuarial firm that costs about $250 to get the assessment back. The assessment comes back and says, this policy is worth, in this example, maybe the number is $50,000 today. So therefore, when you donate it today, you get the receipt or the tax benefit based on the fair market value today. If there's premiums that still need to be paid, you continue to get the tax receipt on those premiums paid every year. And the charity, of course, gets the full benefit of that payout tax-free upon your death, which can have a very large impact. Another option for giving is our IG Wealth Management Charitable Giving program. And this is a fantastic option for somebody who's looking to make a legacy and talking about having something set up that's going to be ongoing in your name and create a memory for somebody. There are lots of people out there who want to do this, who want to have some sort of legacy set up, whether it is, getting a bench at a park or donating, having your name on the wall in the cancer center, something along those lines. And this is another way to do it that can have a substantial impact. Similar to a foundation, however, a lot more cost effective. There's no upfront costs or there's a lot less administration and complexity. It's essentially a donor advised fund. IG has set up a foundation and then allows you to set up an account within that foundation to have an ongoing legacy. It's tax efficient. It allows gifts in kind to charities that don't accept in-kind donations. So for some of our small local charities that maybe aren't set up to accept those in-kind donations that we were talking about before, this is a great way to do that. Be multi-generational. This is something that can last forever. You can set it up today in a grandparent's name, in a parent's name, in a loved one's name who passes away, or in a family name, and you can have that go on and continue to have an impact throughout your life. Your kids can take it over for you, and you can really have a multi-generational impact. The way it's set up is you create a charitable giving account in the name you choose. So we've actually done this very recently. The Kilcourt Group Charitable Giving account, and we'll touch base on that in a minute, is now set up. We make an irrevocable gift, so I have done some donations in kind through my corporation. As you saw, it was more tax efficient, donated in kind through the corporation. What happens is that in-kind donation that happens right away, the tax implications stand in terms of the in-kind donation. And then you also get that receipt up front. So the day you put the money into the charitable giving account is the day you've made that donation. It is no longer your funds. It is a charitable donation. You get that tax receipt in the same day. And then those funds sit in this charitable giving account. And you have the choice as the controlling person, as the advisor on that account, to choose how much you want to give out of that account and to what charities. So you can decide on a year-over-year basis to give any amount from 4% to 100% of that fund to the charity of your giving. And that really can have a huge ongoing difference. You can choose the same charity year over year. You can change charities, and we can set that up. So again, an example, just a great way to go through things. As I mentioned, we've recently set up the Kilcourt Group charitable account. So that was done with an in-kind donation I made through my corporation to set this up. When we did that initial upfront donation, we get the tax receipt this year and are able to use it to save on income taxes this year. Moving forward, that account is set up to give donations to charities that are important to me. So ABCs and Rice is a charity that's really close to my heart. I've been on the board, volunteered there. So year over year, we want to set up a sustainable gift so that they can expect something every year. Our children, our future, again, something that's really important to me. I have kids. I can't imagine what it would be like knowing that I was putting my kids on the bus without a good lunch or warm clothing. So we want to be able to know that we're having a lasting impact year over year. Crime Stoppers as well, really important in our community. Alzheimer's, very close to me because of a loved one. So these are things that we can set up. And now that this account is set up, it can accept donations from myself, my team, my corporation year over year. We can actually also accept donations from third parties. So for Christmas, when I say, I don't really need anything, I'm very, very blessed and fortunate. Why don't you make a donation to the Kilgore Group charitable account? You'll get a tax receipt and I will get to disperse those funds to the charities that are important to me and my family. It's a great legacy that you can set up, and you can pick any name you want, again, after a loved one. So I guess the question is, have you created a charitable giving plan? Are you ready to create a charitable giving plan? And is there, anything standing in your way to making those donations go farther and give more? I want to thank you for taking the time with us today. Again, it just speaks to the type of person you are, being willing to sit through something like this, have a greater impact, and do more with those funds. If we can do more, that is a wonderful thing to be able to do. And let's use those tax savings to help our community locally and globally. So thank you so much again for joining us today. I'm going to take a minute here to see if there's any questions that are coming up in the live Q&A. If there's no questions, we will reach out after the fact. So we're happy to touch base, answer any personal questions you may have. And we're really looking forward to chatting with you, making these things a reality. Again, we're happy to do that. So just looking at the live Q&A, I do have a question in terms of, sorry, let me just read this. So are there minimums in setting I'm assuming that's in setting the charitable foundation up? So the Kilgore Group, typically for clients, we do actually have client minimums to invest with us. But with regards to the charitable giving account, as a company, we will waive all of those minimums. If you just want to set up a charitable giving foundation, we are happy to do that. We would love to go out and see 20 of these things set up next year and have a huge impact. The minimum for that particular account on the initial investment is a $10,000 minimum initial investment to open the account. After that, you can continue on making donations, and that minimum no longer applies. Just looking here. Yes, you can actually get more tax savings than you donate on a corporate donation. That comes up a lot. People don't believe me. Sounds too good to be true. This is not any type of aggressive tax scheme by any means. We are not leveraging into a charity, anything along those lines. These are just the basic tax rules. Understanding how our tax act works. It's very complicated. I guess that gives us job security, it gives all the accountants out there job security as well. It's not a bad thing, but understanding how that works and just taking advantage of it means that you can have a huge impact. All right, I don't see anything else. Thank you so much. I do see the great presentation comment. Thank you very much. I really, once again, want to say thank you to everybody who attended. Let's go out there, run with this, and have a great impact. Maybe for Christmas every year, this is whatever all of you can ask for, a charitable giving account in your name. Thanks again. We'll be in touch, and have a wonderful rest of your afternoon.